All right, hello lovely humans. We've made it to part 3, the solution. Definitely don't watch this until you've at least attempted on your own to calculate the ending value for each of these 4 options, given these average annual rates of increase. And the reason why is because the best way to learn something new is to actually work through it. It's okay if you get the wrong answer. That's why we have this video, so we can compare solutions. But it's really important to at least try, because it gets your brain thinking about solving the problem, and then when you do see the solution, it actually can help fill in the gaps. So you're building on a foundation that you have already worked to establish, rather than kind of starting from nothing. So that said, I hope you've already at least tried and attempted it. It's okay if you get it wrong. Not a big deal. I get things wrong all the time. That's why we practice. So let's look at the solution now. In part 2, we discovered that the total value, the ending value of our $1 investment can be calculated with this general equation. Our initial investment of $1 plus our initial investment times the rate that we are given over here to the nth power, where n equals the total number of years, which is just 94 in this case, from 1926 to 2020, 94 years. Boop. So let's use this equation to solve for each of these 4 options. So option 1, our total value, I'm gonna be lazy and just write TV, equals $1 plus $1 times 3%, or 0.03, to the 94th power. That is going to give us an ending bank account value of about $16.09. Okay, so not a lot, but you made a little bit of money. That's cool. You can treat yourself to a nice lunch or dinner or something. Okay, let's look at what happens if you decided to buy a bond with your $1 investment. Then the ending value of your bond that you would be able to cash in for would be $1 plus $1 times 5% to the 94th power. And now you would get about $98.13. Okay, so now you're like, ooh, I can take myself and a friend out for dinner. Rad. Not bad, not bad. Okay, so now let's look at what happens if you decided to invest your $1 in like a managed index fund. Basically, a person would go and decide where to put your $1 investment. If a company went under, they would take that money and move it somewhere else, so you don't have to. So you wouldn't have to do a bunch of research to figure out if those companies still existed in 2020, because whoever's managing this fund would do it for you. That's pretty rad. Okay, so how much could you expect to earn given this average annual rate of 10%? Well, we have $1 plus $1 times 10%, 0.1, to the 94th power. This is where things get interesting, because now you would end up with a portfolio of $7,778, yes, and 80 cents. What? That's a lot of money. You can do a lot with that. Now, let's look at the most risky option, investing in an actual stock for a specific company. Assuming you did your proper research and the company that you invested in still exists, yay! You would expect an average annual rate of return of about 12%, and this is based on actual data from the US. So the total value of your portfolio, I guess would just be the stock that you own in that company, would be $1 plus $1 times 12%, 0.12 to the 94th, equals $42,314.98. That is a lot of money that you have earned from just investing $1 over 94 years. To be fair, most people will pull out money before 94 years, but what this really shows you is the value of looking at these average annual rates of return. And so this is really the key. Because they are average values, they take into account both the highs when you get more than that back and the lows. For example, these rates do actually take into account the fact that there was a huge stock market crash during the 1930s. Since this is an average rate, it kind of incorporates all of the highs and the lows and it kind of smooths it out. So what I really want you to take away from this is the fact that if you have a long time to wait, if you have many years, even if you only have 20 to 30 years, it's still actually a really good idea to invest in something that can give you a very high rate of return, because you can take $1 and you can, by waiting, earn a lot more from that. So the last thing that I want to say is to kind of give you the financial advice that was passed down to me from my dad, who's an economist. So I would recommend, if you're just getting started in investing, you want a little bit of everything. So for example, I have money in a bank account, I have money in bonds, although since I'm young and I have a long time to wait, I don't have as much money in bonds as I do in these more riskier options. I have managed mutual funds and I have investment in stocks of specific companies. And so because I am young, I can be a little bit more risky versus my parents who are much older, and they have been moving their money into more safer options like bonds as they've gotten older and as retirement gets closer. So even if you only have a few dollars to invest, if you're young, even if you're in your 30s or 40s, if you're looking to retire in your 60s, it's still worth it to put some of your money in slightly more riskier options. If you're less risk averse, I would recommend managed funds because someone else will kind of take care of the risks for you. And even if you decide to go with a low risk option like bonds, you can still get a much better rate of return than you would just keeping your money in the bank. So I hope that is helpful. Please let me know if you have any questions about financial literacy. I'm not an expert by any means, but I do have a little bit of valuable information to share, and I'm happy to help with whatever I can, or at least to provide you with more resources. And if you have any questions about the mathematics that we did here or other math topics, please let me know and we can tackle it together. Yay! Thanks very much for watching, and we'll see you next time. Bye!